Alrighty, thank you everyone. We did want to come here and kind of preface this today with, we are not a consulting firm, we are not professionals in this by any means, but what you see here today was actually built over the course of 90 days, from having an idea to tool selection to scoping it out, building it out, and finally showing off the final product. So it was a quick turnaround proof of concept type of projects. And so today we'll talk about what Fannie Mae is and what we do. And sorry for the jumble up in the slide a little bit there, but we operate in the US secondary mortgage market. So if you reside here in the States, you've probably heard of us and really don't understand what we do. If you are international, you've probably never heard of us since we only operate here in the US. So Fannie Mae, and I said we operate in the secondary mortgage market because we are kind of like, you can think of us as the bank to the banks, right? So as we individuals go to a bank to obtain a mortgage, the bank would then sell that mortgage to Fannie Mae. We would then create various securities or investment vehicles out of that mortgage and then reimburse the bank so they can go and write more mortgages. So that's what we consider providing liquidity to the housing market. So think of it as, if, say, a Bank of America or Wells Fargo just wrote all of these loans, they wouldn't have any money left to make any new loans, right? So basically Fannie Mae provides them with the liquidity to keep turning that over and making more loans, which at the end of the day makes things like the 30-year fixed mortgage possible here in the States. So it's a little bit of a different structure than what they have out in the rest of the world. So this diagram here just kind of gives an overview of that. So working right, we've got the lender on the far left. They write a loan to a borrower. They then sell that loan to Fannie Mae. Now Fannie Mae does one of two things with it. We either bulk those loans into what we call MBS, which is a mortgage-backed security. We pool them with like loans into a security, and then we sell that security on the open market to investors. So typically institutional investors looking to invest in interest rate and mortgage risk. The other thing we do down on the bottom there is we create what we call these credit risk securities. So these are part of a risk sharing type of model where these investors will actually share in part of the risk with Fannie Mae as a means of kind of distributing that risk around. So hopefully, fingers crossed, if another financial crisis should hit, it wouldn't be as big of an impact to any one entity. So as mentioned in my intro, I lead our operations, modeling, analytics, reporting function, and basically what operations does is we process the transactions for Fannie Mae. So these can be anything from the folks on the front lines that actually acquire the loans from the banks, make sure they're good to go, to the ones that package them into those securities, to the folks that handle all of the paperwork that goes along with a mortgage. So if you've ever gotten a mortgage, you know that there's a thick stack, about an inch thick, of paperwork that goes along with it. That paperwork actually has to go somewhere, and we actually have vaults and people that handle all of that paperwork. To what we're demonstrating here today, which is actually in our capital markets operations functions, where we actually trade these securities with external investors. So that's kind of what we'll be showing today. Our main business challenge, we had a few things that we were really focused on. So for those of you that are a little more familiar with the financial system, Fannie Mae and our counterpart Freddie Mac are currently under government conservatorship. So we've been that way since October 2008, when the housing crisis was in full swing, and we were really uncertain as to what the future might hold. So we need to kind of be prepared for anything. So a lot of this is to address various scenarios. So what happens if this were the outcome that occurs? One of the main ones we wanted to look at were business resiliency strategies. So we've got our main operations in the Washington, D.C. area. We've also got another site with a few thousand folks in Plano, Texas. So we wanted to test out various resiliency scenarios. If something should happen to one of those main sites, can the others pick it up? What would it mean? Can we still fulfill our obligations? So why do we choose AnyLogic? So like I said, it was 90 days from initial inception through tool selection. So we finally settled on AnyLogic for a few reasons. One being it's very flexible, as you guys know. Another being you can do visualizations that make it much easier for non-technical folks to understand. So our business customers in this case are finance professionals. They're not statisticians. They're not simulation professionals. So being able to explain things to them in a meaningful way that they can grasp the concepts and really try and make decisions based off of it was kind of key for us. So as we looked at AnyLogic compared to other tools, that was one of the main things that kind of took it into AnyLogic's direction. So now to walk you through the basics of the simulation and the demo, I'll turn it over to Fang Dong, who will give you some of the basics, and then turn it over to Vítor to run you through the actual simulation.
Hi, so I just quickly go through the business background of the simulation we did last year. So as John already said, that was like a demo. Then the goal was just to prove how can we use simulation to better support our operations, if even that's possible. And the two processes we picked are from the capital market operations. So they're trade confirmation process and trade assignment. So for trade confirmation, as it says, is actually once the trade got booked, so it has to go through the trade confirmation before the final settlement. And in that process, our analysts just compare the trade agreement from both counterparties and to ensure the accuracy of the execution. And also, they have a very strict SLA to fulfill to finish this confirmation process. And for trade assignment, actually, part of the booked trade is actually from trade assignment, which is when the selling party is assigned their obligation to Fannie Mae. And then Fannie Mae can either assign the trade to a third party or assign to ourselves as a buyer. And then after the trade assignment, you still have to go through the trade confirmation process. So this is the relationship of these two. And the basic model assumptions is just that trade is going to be the major task go through the system, and we use a person arrival for the trade coming get booked. And also the other agent is our analyst. And so basically they are handling the manual process. And here we just use the assumed triangular distribution for the manual process. And for application, so here, right now we're focused on two areas. So the first area would be capacity management. So how many analysts we need to fulfill all the SLA to finish this process, or how can we cross-train our analysts to have more efficiently to use their for their utilization. And third is that when the trades going up, the volume goes up, and how much capacity or actual capacity we need in that case. And the second area is for the process evaluation and improvement. So as John mentioned, we want to, how can we identify the potential bottleneck? And what if we have a process change or we have new process, how can we test it before actually implement that? And given those two capability, so it's definitely in line with our business strategy, the business resiliency, which is one of our top business strategy currently. So with that being said, I'll hand it to Vítor to go through the detail of the simulation. Yep.
Okay, here goes. So you guys can see here, this is the main dashboard where the management, anybody else can see what's going on with the process, and they can change the nodes and figure out what they want to see. So just a quick overview here. So on the right-hand side up, you get the daily trade volume. So here we set up to be 4,500 trades booked per day. And 1,000 of them actually have to go first through trade assignment. So it has a split there. So often we have some exceptions that we have to take care of for the trades. And then they actually take a little bit more, longer than the regular processes. And actually can here customize what happens if both exceptions are treated in 2 hours. You can change that to 5 hours, 20 hours, whatever you want to be. And then there's also two types of trades. trade A and trade B here. And we set up the ratio to be 55% to trade A and 45% to trade B, but you can actually change that. And then for resiliency purposes, we have two headquarters, one and the second one. So as you can see, the blue one will be the headquarter one, and the yellow ones will be the knobs for headquarters 2. And the top blocks for analysts type A and B, actually, so analysts they actually can only work on the confirmation process. And for tasks X and Y, it will be definitely the ones who work for trade assignment. Some of them actually cross-trained.
So one thing I want to add, so all the data here is like a mock-up data. So
Yes,
maybe the
mock-up
result
data,
doesn't
yes.
make any sense because we have to
Yes.
do that.
Yeah. So don't invest money on this. Oh, here you go. So here you guys can see for what we set up. This is the daily trade volume will be on the left side. Of course, we have weekends. We don't do trades over the weekends. The automated process still can go forward, but not the manual ones. And you can see that this is going very fast. Sorry for that. But here's the confirmation process. You can see how all the trades are going through, and we have some bottlenecks. And here would be the statistics. So 30% of them need to be modified, and the rest will be confirmed. You can check how many hours and days we spent on. So now that's going slow. I can explain what happens here. So our goal is always to finish and confirm all the trades within 48 hours. That's why on the right-hand side we are tracking how many of the trades we actually did before 48 hours, or between 24 and 48, or over 48. So you can see on this experiment, over this period of time, over a month, I think it's a month and a half, we did 156,000 trades, and only 25 went over 48 hours. The good thing about this, you can actually track who is at the maximum capacity. So here the tri-tip analyst A is actually a max capacity. We are overworking them, I guess. And the other ones are not as much. The good thing about this, about AnyLogic, we can actually put the business hours, and headquarters 2 might have a different time zone than headquarters 1. And the proficiency also changes, so we actually, since it's engine-based, we're able to say these type of analysts are faster than the other ones, and what would have happened if we hire somebody else who's not up to speed yet, how it's the improvement in the whole system. So the next one is we're going to test what happens if we have huge peak in volume for, let's say, 6 consecutive days. What would have been the effect of that? So same thing, same parameters, but here I will go and do 372 times the regular volume. This will show up at the second week. So the first week is, again, 4,500 trades per day, and then, boom, you're going to see now. And then you're going to see that, of course, soon enough, we're going to start missing a lot of SLAs. Everybody's super busy. They're working a lot, and the volume just keeps going up. And in the simulation, we actually don't recover from it. You see that still missing a lot of SLAs, and we are already at 5%. And I think, although this is, there was a video, so I don't know for sure, it's going to be like 13, 14%. And so this is a good way to test what happens if all of a sudden we have a huge spike in volume. So this is for sensitivity analysis and resiliency. And let's see what happens at the end. So we missed 30,000, so which was a lot. And then you can see how the trade A was, people were actually highly utilized. So we also did for resource optimization. So here we changed a little bit of the thing. So we wanted to see what happens if you have a 72 hours SLA. And we don't want to miss in over a whole month any SLAs. So how many people actually we will need for that kind of distribution. We changed, of course, the trade books. Everything is a little bit different from the previous simulations. And the good thing is we can actually realize that we will need 7 type A analysts, 12 type B, and for process assignment, we just need 1 for X and Y. This process is pretty fast and mostly automated. That's why we don't need as many people. So this was a good thing to realize how many people do we need and where we can actually allocate resources intelligently in order not to miss any type of SLAs.
All right. Thank you.
Thanks.